Hello, everybody. Not so much geopolitical today. Let's drill down into the markets. What's going on out there? And today, I have visual aids because I am joining the 21st century, a quarter of the way through it. How's this for a visual aid? All right, this is the Dow Jones Industrial Components. We've got 2/3 of them are down year to date. So let me explain this. The Dow Jones has now given up all of its gains for 2023, and it's all happened in the last 6 weeks. Now look at this list. Look what's down double digits. We got Chevron down about 10%. All right, a lot of that has to do with their merger, but keep going down. Nike down 12, Goldman down almost 13, Coke down 15. Honeywell down 15. Go to the bottom. Walgreens down 41%. Wait, what's going on here? This is across the board. We've got consumer products, we've got banks, we've got insurance companies, we've got defense contractors down double digits. If it hadn't been for, look at the bottom, Salesforce up 52%, nice. Microsoft up 37%, nice. Apple and Intel, you can see it. If we didn't have these four, the Dow would be way down for the year. So we've got four stocks basically pulling the wagon on the Dow Jones Industrial Average, which again has now given up all the gains for the year. And remember, last year was horrible for stocks. So let's go to the next one. The S&P 500, because people say, yeah, Greg, the Dow only represents 30 stocks. Well, that's correct. So let's look at 500. All right, the top 500 stocks in the country are up 5.75%. That's good news. The S&P 500 is up that much for the year. But without those three stocks at the bottom, NVDA is NVIDIA. That's the AI craze. And if I showed you guys a balance sheet on what NVIDIA looks like, it looks like .com 23, 24 years ago, down she went. Meta, that's Facebook, had a horrible year last year, so it's recovered. And Tesla is recovering from a horrible year last year. So we've got the little picture there, attempted humor. We basically have three stocks pulling the wagon in the S&P 500. I guess you could add the four that we had on the other, Salesforce, Apple, Intel, and what was the other one? Microsoft. What we say is there's not much breadth. What you want when a stock market's going up is, 400 of the 500 S&P stocks going up, 20, 25 of the Dow stocks going up all together. We only have a small group pulling the wagon. That's not the sign of a healthy market. Moving on. Sometimes the headlines just really help you. And today, two of them popped up. Fed admits banks suffered massive deposit outflows last week. All right, let's pause there. We've talked about this in our videos before. What's happening? We have an electronic run on the banks. Over $1 trillion has left the banking system in the last year. Where's it gone? Most of it's gone to government. If you have a 90-day treasury bill paying 5.5% and a bank can only pay 2 or 3% on savings, what would you do? You pull money from the banks and you give it to the government at the higher rate. Plus, you don't have to worry about the government going bankrupt like a bank can go bankrupt. And so looking at the banking index, look at the next headline. Bank stocks crater below March crisis bottom, hit 3-year low. Here's what's coming next. And what they're predicting next is banks are going to have to borrow more from the Federal Reserve in order to keep their cash balances up. Well, when you borrow from the Federal Reserve, you got to pay them interest. Plus, you've got to send collateral up for the borrowing. This is banks getting desperate for cash. And I know a lot of you are cheering out there right now saying, look, bank CD rates are 5% or 4%. That's good for you, but the banks don't want to pay that. What it's telling you is the banks are desperate for cash. All right, moving on. So if that's losing, what's winning? Let's go here. Headline from today. Gold and crypto surge, stocks purged as USA credit risk rises into World War III. Whoa, wait again. USA credit risk? What's going on here? Look at the chart below. These are federal interest payments on our debt. All right, I don't know if you can read the federal doom loop, but government spending is up 14% year over year. That's what the YOY stands for. Well, wait a minute. Government spending was supposed to come down after the COVID thing. It's kept on going up. Yep. Meanwhile, tax receipts are down 7%. That's a pretty big gap. And everybody tells you, oh no, we're not in a recession. It's going to be a soft landing. It's all good. Look at the GDP numbers, which Walt will address here in just a minute. But you know, you can game numbers. You can game the unemployment rate and the inflation rate, but you can't game tax receipts. Either they're up or they're down. They're down. Meanwhile, the debt has exploded. We've talked about that before, and the interest rates are higher. We are now nearing $1 trillion per year just in interest on the debt. So, what does this mean to you? If we now go back to the last 2 weeks, everybody's saying, I want a safe investment. What have the safe havens been in the last 2 weeks? Gold, oil, and Bitcoin, which is what this headline talked about. We're in the right stuff. We don't do Bitcoin. We can discuss that in another video. There are reasons for that. But gold and oil are telling you something. That's what the world is perceiving as safe space. Not dollars, not bonds, not stocks. And this is where we have you positioned. So unfortunately, it's bad news out there, but it's good news in here for your portfolios. And that's our objective. Let's get you through this. And on the other side, are we hopeful for what can happen? Absolutely. But for now, commodities, oil, gold, this what you've heard before, is the place to be. And now I'll turn it over to Walt.